Welcome to Value Vest Daily. Today, we're diving deep into a metal that's quietly becoming the absolute backbone of our future.
We're going to be unpacking the powerful economic forces that are sending some serious shockwaves through the copper market. You see, we're on the verge of what many are calling a supercycle, and it's being driven by a perfect storm of just soaring demand and a really critical supply crunch. So let's break down what this all means for the global economy and, of course, the investment opportunities it might be creating.
So, what's all the fuss about? Well, it really comes down to this one number, $13,000. That is the record-breaking price per metric ton that some top analysts are now forecasting for copper, a price that would totally shatter all previous records. Now, to put that into perspective for you, that's a jump of nearly 30% from where we are today. This isn't just a little bump, it's a huge signal of a massive shift happening under our feet. And to really wrap your head around the scale of this, we need to start thinking about copper in a whole new way. I love this saying, copper is the new oil. It just perfectly captures its importance. You know, just like oil powered the entire 20th century, copper, well, it's the non-negotiable metal for the 21st century economy. Without it, the future that we're all talking about, it simply doesn't get built. Okay, so what in the world is behind this incredible price pressure? Look, it's not just your regular everyday economic growth. What we're witnessing is what you could call an electrification tsunami. This demand shock is coming from three massive global trends that are all converging and hitting at the exact same time. So first up is the green transition. And this chart right here, it tells you everything you need to know. An electric vehicle needs about 83 kilograms of copper. Compare that to just 23 kilos in a traditional gas-powered car. That is almost 4 times the amount. Just think about it. All the wiring, the battery, the motor, it's loaded with copper. So as the world shifts to EVs, the demand for copper is set for this just explosive structural increase. The second major driver is all that renewable energy infrastructure. You know, solar and wind farms are incredibly copper intensive. And we're not just talking about the turbines or the panels themselves. We're talking about the immense amount of high-voltage cabling you need to connect these farms, which are often in really remote places, all the way back to the national grid. It's a colossal undertaking.
And here is the newest, and honestly, maybe the most powerful catalyst of them all, the AI and data center boom. Get this, by 2027, AI servers could consume as much electricity as a country the size of Sweden. Now, to power all of these new data centers, we need a complete overhaul of our electrical grid. That means millions upon millions of tons of new copper for wiring, for transformers, and for substations. This is not some optional upgrade. It's the price of admission for the AI revolution. So this all brings up a pretty logical question, right? If demand is this high and prices are set to soar, why don't we just, mine more copper? Well, that's where we hit the second half of our story. The Great Supply Cliff. And believe me, the answer is a whole lot more complicated than you might think. The single biggest bottleneck for supply is just time. Simple as that. From the moment a new copper deposit is discovered to the day it actually starts producing metal, you're looking at, on average, 10 to 15 years. It's this long, complex process of permitting, environmental reviews, and, of course, construction. So think about it this way. The supply we're going to need in 2026, that project should have been started way back in 2011. And on top of that massive time lag, we've got two other major problems. First, falling ore grades. Basically, we've already mined most of the easy-to-reach, high-quality copper. So now, miners have to literally move more earth just to get the same amount of metal. And that drives costs way up. Second, there's geopolitical friction. Key producing nations like Chile and Peru, they account for almost 40% of global copper production. They're facing political instability and labor strikes, which directly threatens the supply chains we already have. So when you smash together that demand tsunami with this supply cliff, you get what experts are calling a structural deficit. And let me be clear, this isn't just some temporary blip on the radar. It's a long-term situation where demand is projected to consistently, year after year, outpace our ability to produce. That creates this sustained upward pressure on the price of copper for what could be years to come.
Okay, so we get the why. Now let's talk about the so what, especially for investors. This incredibly powerful market dynamic is creating what could be a generational opportunity. So let's open up the supercycle playbook. Broadly speaking, there are two main paths you can explore to potentially play this boom. On one side, you've got the direct plays. These are the mining companies themselves, the ones literally digging the stuff out of the ground. And on the other side, you have what you might call the picks and shovels play, the tech enablers that provide all the critical gear and software for this entire ecosystem. Let's start with the miners. These companies can act as a leveraged play on copper prices. What that means is their costs are relatively fixed, right? So as the price of copper goes up, that extra cash flows almost directly to their bottom line. You've got companies like Southern Copper, ticker SCCO, who some call the reserves king because they have the largest copper reserves out there, giving them a really long runway of low-cost production. Then there's Teck Resources, TECK, which has made this really smart strategic pivot to become a pure play on these exact energy transition metals. And of course, you can't forget Freeport-McMoRan, or FCX, a major producer right here in the US. Now, the second strategy zeroes in on the technology that makes this whole boom possible. Remember how we said miners have to work with lower-grade ore? Well, to do that efficiently, they need automation from companies like Caterpillar, ticker $CAT. And to handle all this new electricity from EVs and AI, the grid itself has to get a whole lot smarter with tech from companies like Eaton or $ETN. These are the guys selling the high-tech brains and brawn behind the entire copper rush. Now, it is absolutely crucial that we take a step back and have a balanced perspective here. No investment thesis, I don't care how compelling it sounds, is ever without risk. So before anyone gets too carried away, let's run through some really important risks and reality checks. This table lays it out pretty clearly. On the upside, you have the powerful factors we've been talking about, the structural deficit, the huge AI and EV tailwinds, and even potential tariffs that could boost prices. But the downside risks? They are very, very real. A major slowdown in China, which, by the way, accounts for over half of all global copper demand, that could dramatically change the picture. Prices can get frothy because of speculation, and there are always risks of delays in getting those new mines running. And you can be sure there's going to be volatility. And this brings us to a very important point. This is an educational explainer. It is not financial advice, and it's not tax advice. The market is incredibly complex, and you should always, always do your own research and consult with a professional before making any investment decisions. So, we'll leave you with this one final thought to chew on. When you really consider its central role in electrification, in renewable energy, and in the artificial intelligence revolution, you just have to ask the question, is copper the single most critical commodity for the next decade? It's a question that could define a huge part of the investment landscape going forward. Please subscribe, like, and share ValueVest Daily for daily learning opportunities before you put your money to work. And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. Thanks for tuning in.